going to your slide 13 and 14, it looks like Bloomberg estimates are lower than those for Hedgeye on GDP. If consensus has already come your way, are there greater risks in achieving your expected outcomes?
Yes, I mean, sure. 2 out of 3 so far. If it's all priced in, you just buy stocks. That's absolutely the answer. I don't know what to say about that. I mean, that doesn't predict. We've never made a presentation, and we would have because we backtested it. We've never made a presentation that says buy stocks if the GDP number is lower than or higher than the Bloomberg estimate. We've said get the trending rates of change of the cycle right, and you get full in-cycle investing right. So that's the full cycle investing rate. That's what we want to continue to pay attention to. We don't want to do the old wall way. We don't. If you want to look at GDP versus the Bloomberg estimate and say, okay, I'm going to go whole hog 80% net long, with full semi exposure right now, you can do that. But that's not what we're telling you to do. So again, we're just illuminating those numbers and saying, hey, look, it's gone from 4 to 3 to 1. Yeah, if the street's getting close to 1, great. What does that mean? Does that change our view? Absolutely not. It might get me quicker to cover some shorts like yesterday. I mean, I took 14 shorts to 7 in real-time alerts. Yeah, you can do that. When the VIX is between 14 and 20, absolutely. But what happens when it goes to 30? When it's not that number actually that you'd be concerned about, which is the next set of companies missing that you'd be concerned about. So again, not trying to reduce the questions to questions that just are we don't pay attention to. But again, our process is our process. We're trying to get the trending rates of change of growth, inflation, and profits right across the full investing cycle.
Yeah, and I'll also add that there's a lot of downside to our estimates in terms of where the balance of risk is skewed.
Yeah.
If you look at that table on slide 27 where we show our growth, inflation, and profit scenario analysis, that scenario analysis assumes for each successive sort of interval the trending, the trailing 3-year sequential momentum. If you think about what we've seen over the last 3 years, we had the Shanghai Accord, we have had corporate tax reform, we had obviously Trump's election, sort of ignite animal spirits in the late 2016. We've had a lot of really good things happen over the last 3 years. Mm-hmm. Oh, and by the way, we've had a huge fiscal stimulus package in terms of the spending. That's about set to expire in September or at the end of September. A lot of good things that we've seen in the rearview mirror. It's very dangerous to extrapolate that forward as it relates to how difficult the base effects might be as we progress to the back half of the year, and that's why we see things like this morning's durable goods print, which is obviously a surprise to the downside relative to where we were this morning.
And by the way, the question was asked inaccurately. I mean, if you look at the slide 14, I'll still answer the question the same way if it wasn't inaccurate. But if you look at the reality, we are below both Bloomberg and consensus and the Atlanta Fed. So the Atlanta Fed's got to cut by 50 basis points to get to our number. If they do it tomorrow and they're in line, then whatever. I still wouldn't chance the point. And by the way, if you look at this again in a different way, it's not looking at data, it's what you see. When's the last time you saw a 1 in front of GDP? That your average macro tourist, which there are many, has seen a 1. When was it? On the lows back in 2016, eh?
Yeah.
Hey. Ooh.
It's good hairy.
Yeah. Between the lows of 2016 and now, USA, nobody's seen a 1 on GDP.
Yeah, that's a good point. Yeah, if our number's right, that's going to be the lowest since Q1 of 16. Yep. There's a guy in the Oval Office who's probably not going to like that.